Greetings, Main Street. You asked me to do this, so I'm going to do it for you every single Monday. Let's dive into what's been happening in the world of finance last week. Welcome to the Main Street Money Market Update. U.S. stock indexes have had a bit of a bumpy ride, ending the week slightly higher. The S&P 500 managed a 0.5% gain, breaking a streak of 4 weekly losses after recently dipping into correctional territory. It's nice to see some positivity in the markets. I always welcome that. However, the tech sector, group of stocks has recently led the charge in recent years, has been struggling. Just straight struggling, man. This year, the tech stocks are down about 9%. A stark contrast, they're nearly 37% in 2024. Looks like they've hit a bit of a rough patch. We'll see how they turn out. What's the Fed going on? What they got going on? Well, they're still taking a cautious approach, keeping the benchmark interest rate steady at 4.25% to 4.5% for the second week in a row. They're holding tight on their plan for 2 potential rate cuts later this year, but have lowered their growth forecast to 1.7% from 2.1%. They're also expecting inflation to rise a bit, now projected at 2.7% for 2025. Stay on the lookout for how that impacts you at the grocery store. And another move, the Feds will slow down its balance sheet reduction program, which means they'll be a bit more active in the Treasury bond market starting in April. This could help stabilize bond prices and keep interest rates from climbing too high. We'll see how that goes. Meanwhile, across the sea, man, Europe is doing pretty well. Stock market performed in Europe has performed well compared to the U.S. market. The European index has shown about a year-to-date return of 14%, while the S&P 500 is down 3%. If you're thinking about diversifying your investments, Europe is definitely looking pretty strong right now. Meanwhile, retail sales disappoint with a lot of different protests, so looks like they might be impacted. We'll see how it turns out. In retail news, the latest figures show U.S. retail sales fell short of expectations again, with only a 0.2% increase in February when economists were hoping for a 0.6% gain. January's sale numbers were also revised down, indicating a slowing in consumer spending. UK holds firm on rates across the Atlantic. The Bank of England decided to keep interest rates on hold at 4.5%. They're being cautious due to inflation concerns and global trade uncertainties. Looks like they're keeping a close eye on the situation. Meanwhile, I wanted to dive into this a little bit. The share buybacks are on the rise. This is big. In corporate news, U.S. companies ramped up their share buybacks in 2024, spending nearly 19% more than in 2023. This indicates that companies are feeling confident about their future, with a record $943 billion spent on buybacks last year. Definitely keeping an eye on that. A lot of questions about tariffs. Well, as we look ahead, tariffs are a hot topic that can significantly influence the economy. The Fed is adopting a wait-and-see approach regarding tariffs, as they expect that these trade policies to slow economic growth and cause a temporary spike in inflation. We'll see what happens in the long run. With the administration planning to announce more details on tariffs in early April, so keep an eye out for that. We'll keep an eye out for you. It could bring some clarity to an otherwise uncertain situation. Tariffs can lead to increased costs for goods, which may ultimately be passed down to consumers. This could impact everything from the prices we pay for everyday items to the overall health of the economy. So it's essential to keep an eye on how these developments unfold, as they could in fact affect both your wallet and investment strategy. So what does this mean for you? You know, that's what Main Street is about. What does it mean to you? Number one, consider your investments. With the tech sector struggling, it might be time to reassess your investments. Talk to your advisor about it. Look into diversifying with international stocks or bonds, especially since Europe is performing well. Number two, keep an eye on interest rates. The Fed's decision to hold rates steady means that borrowing costs won't rise just yet. If you're thinking about a loan or a mortgage, now could be a good time to explore your options. And number three, stay informed of retail trends. With retail sales showing signs of weakness, it's essential to stay informed about consumer trends. This can impact everything from job security to stock market performance. So we'll definitely keep an eye out on that for you. So last week brought a mix of news, but staying informed will help you navigate the financial landscape. The Fed is cautious. The tech sector is struggling, and in Europe is showing strength. And with tariffs on the horizon, it's crucial to keep an ear to the ground on how these changes might affect you, and we're going to be helping you do that along the way. If you have any questions or want to chat about what all this means for you, feel free to reach out. Our economic hotline is always open, 917-809-4231. Again, at 917-809-4231. At the time of filming this video, Dow Jones is having a good, it's Monday morning, right around 10:15. Dow Jones up over 515 points. S&P up about 1.5%, almost 85 points. NASDAQ up 335 points. So it looks like the markets are doing well trying to climb back. We'll see how the week unfolds and be back to you next Monday with another market update to tell you exactly what happened. Be the change. Peace.